to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Hey, if you guys have any questions, any comments you'd like to make, feel free to call us 216-901-0945. Like the guy said, I am Bill Bullington. I'm here every Saturday morning from 11 to noon, ready to try to help you by answering any questions I can. If I can, I'll look at the answers up and get back to you. And it's interesting. We've had a lot of stuff going on today, over the past week. I don't know if you've seen the price of gold. I am not a gold bug by any stretch of the imagination, but I have a client who knows more about this than just about anybody I know. And so we had a good conversation, and there's a little bit of it in my portfolio now, not a lot, by the way, because in the long run, it's been a very difficult thing to gauge. Nobody really knows where the price is going to go. That's the problem with most commodities, especially something that, like a precious metal. It's very, very, very difficult. But under these conditions, I don't think it's all that bad to have a little bit in there. And it's actually in some of the ETFs that I manage anyway. That's one of the reasons that I didn't pay that much attention to it, because I knew I already had that base covered and was helping the overall portfolio. And so tons of crazy ads on that kind of stuff. It's really interesting to see what's happening. Typically, it's a psychological thing, in my opinion. It's what people go to when they think there's going to be really high inflation. And I will tell you that based on what the Fed's been doing, and I think they've been doing a masterful job, so is the Department of Treasury, keeping up the economy until it can get back on its feet again, because the economy is going to recover. There's no doubt in my mind that it will recover. And the government is doing unprecedented things, sending out checks, keeping people from losing their houses and cars. And ultimately, at some point in time, it may lead to higher than normal inflation. That's why gold is running so much right now. Because, and by the way, why didn't it start running, a couple of years ago? Some people say it did, but actually it went down a lot and then came back. So from its all-time high, it's not that far away. In other words, if you just bought it and held it for the past 15 years, you're like, wow, I could have made more money in a savings account. But anyway, maybe it's time. Maybe it's time. Don't know. Actually, anybody that claims to know that doesn't know what they're talking about, or they just don't want you to know what they're talking about because they're trying to sell some gold. A lot of it gets marked up. I mean, there's a big markup in gold when you go out to buy the metal, and there are lots of different ways of doing it. I was trying to talk my client into coming on the radio, and he just said no. Yeah, he's afraid. I'm like, all right, I understand. When I first started my radio show, I think for first 6 months, I put a bag over my head so nobody could see me. I'm just kidding. Kind of. But anyway, somebody asked, by the way, why does he keep joking? Why does he keep laughing on his radio show? I guess, the long and short reason is that this is kind of boring for me now. Not the show, just financial markets. Okay, this is not the first time something like this has happened, and it's happened around the world in multiple countries. Every few years. So, is it a little bit different this time? Yes, it is. This is being brought about. All the economic hardships are being brought on by a disease, and that's that hasn't happened since the early 1900s, long before most of my clients were born. Actually, long before any of my clients were born. That was over 100 years ago. Not that I think about it. And I don't have any 100-year-old clients anymore. So it's really interesting how life just kind of unfolds, and some things tend to repeat, although not exactly the same way they did before. So when people say history repeats itself, or this time it's different, they're both right. They're both right. History does have a tendency to do some similar things over time, but it's never quite the same. And where are we now? Well, now we've got interest rates that are so low that that's a problem. It's been a problem. The past 5 years, the average bond portfolio has been, about 2% a year net of expenses, and some of them have lost money. By the way, the commodities index is negative big time over the last 5 years. So if you had one of those ETFs that was in gold and silver and corn and whatever else, then it's actually lost a lot of money over the last 5 years. So, and by the way, when you're in a big pension plan, they're almost obligated to carry some of that stuff. They don't carry a lot of it, but they have to carry some of it. And I know that bothers a lot of them because they have to carry that asset class, because at some point in time you might get much higher inflation again. And then when it does, that fund will probably do very well. So anyway, here's where we are now. I've been talking a lot about a product that, a specific product. It's a type of a product. This is not the only one. It just happens to be my favorite, at least right now. I keep tabs on these things, and if another company with a equal quality credit rating comes up, I'll start to talk about that product, because I'm not naive enough to think that things aren't ever going to change. But for right now, there's a product that guarantees an income. It guarantees an income, and this is what you're doing with this. This is very important. I don't make blanket recommendations. I'm not a one-size-fits-all kind of a guy. I really believe that you've got to do what's right for you, and you got to know yourself fairly well. You have to know what kind of risk taker you are. How much risk do you want to take on? Do you want to try to pass off some of that risk to someone else to manage for you? And that's actually what this is for. It's passing off some of the risk to someone else so that they can manage that for you. And by the way, Nationwide's a pretty good risk manager, very good risk manager. And it's kind of a big deal. If you want more information on this, just email me. Go to my website, bullingtoncapital.com. Say, look, I heard you talking about that thing that has a guaranteed income. Now, the guarantees, incidentally, are only as good as the underlying companies that are making them. The reason I'm talking about this in this tone and going into so much detail, I got emails from this guy. It was forwarded to me. Very nice man. He's being given information that is so one-sided that it's just, that's not cool. You need to tell both sides of the story, because there's risk to everything. There is risk to everything. There's risk in treasuries right now that are paying 0.5%. You know what the risk is? It's called inflation. That's a tough one, because most people you don't see inflation. You just notice that the food prices are going up in the grocery store. You notice that when you went to buy some clothing that you paid a little bit more maybe than the last time you did. And it's really hard. That's hard to track. That's why I called it the silent thief, because nobody's really watching it. It's not making a lot of noise. You just notice that the prices start to creep up over time. And when you do stuff like what's going on right now, where the government's doing the right thing, they're trying to keep the economy on track. They're trying to keep us from going into a depression. And I can't tell you how many people are complaining about that. I'm like, are you? You just don't get it. Okay. You just don't get it. They're trying to, and they're doing a wonderful job. And they've done things that they've never done. They've done things they've never done, and it's carefully thought out. Is it going to be perfect? Excuse me, but we're still human. Humans are never going to be perfect. Is it going to be better than doing nothing? Yes. That's my opinion. It's a lot better than doing nothing, because doing nothing means you end up just like the 1930s when, who was it? Woodrow Wilson. The prosperity is just around the corner. All you got to do is wait. Just sit on your hands and wait. Really? That's why all those people lost their homes. The banks called the notes. That's why all the banks failed, because you did nothing. And these guys are doing something. I really like it. In fact, we're the grand experiment in America. You Google that phrase, you'll see several definitions on it. But in my mind, the real grand experiment was the monetary system, the banking system. It is what has funded everything that we've done, and one of the reasons that we're the world's top economy. That's my humble opinion. And it actually, a lot of the stuff that we've been done has been adopted by other countries who are starting to catch up, which is a good thing. And some of the things that they've done and have had a lot of success with, we're now starting to do. And I'm thinking, hey, that's an even better thing. Is it challenging? It's always going to be challenging. It's called life. Life is challenging, if you haven't noticed. And if you haven't noticed, it's because you're under the age of 18 months, and those terrible twos are just around the corner. Yes. But I'm here to tell you that you can get through it. I have complete confidence in the system. I have confidence that they're doing a lot of the right things. Is it going to be perfect? No, it never is. But do you need perfection to reach your goals? Probably not. You don't actually have to have perfection. And I think that there are certain areas, investment areas, that are being helped out tremendously from this. Now, I'm going to refer to my unofficial analyst on the gold when people call and ask about that, because I talked about it. I'm calling him. But when it comes to stocks, bonds, I'm going to go back to my research and do what I know is the right thing. And here's kind of where we are right now. If you're a young person, and you're interested, or let's say if you're more than 10 years away from retirement, if you're more than 10 years away from thinking about retirement, I would be looking at the healthcare industry. I have a model. Again, reach out to me. I'll be glad to send it to you or talk to you on the phone about it before I send it, because I have a licensing issue there. The company wants to charge. I'm not allowed to send everything out mass to everybody. So I have to have a brief conversation or an email. Email works, but it's got to be one-on-one. You can't just send it out to a group of people. And just ask me. I've got two different models I like to kind of add to the models that we're running now. Investment models. And one of them is healthcare. The other semiconductors. You heard me talk about that a lot. They are actually, both of those industries are benefiting from what's happening right now. And, it's kind of sad, but at the same time, that's the silver lining, I think. And by the way, these are all just my opinions. And if I can be wrong, I am wrong. Occasionally, everybody's wrong. But when you look at the age of the population in the United States and around the world, for that matter, the fastest growing segment is above 60. What happens when you get above 60? Well, you start to get, your body starts to wear out. You start to get tired. And that's kind of tough. It's expensive. There's a lot of medical expenses involved with that. So, and you have two choices. Either, take care of yourself, health-wise, or you end up going away. And sometimes you can't help it anyway. But the bottom line is, it's demographically, it's in a good place. And there are a lot of companies doing a lot of good there. And their sales are going up nicely. Look at the semiconductors, all this work at home stuff. Man, we are to the point now where actually we've gotten so used to it, and in fact, I don't know, I was probably 10 years ago that I bought everybody in the office the kits to be able to work from anywhere we needed to. And we've got our custodians have the world's best security. That's why we use them. And there's nothing that we can't do from home that we can do in the office. So this has really not really affected us too much, other than the fact that you just like to get out of the house and like to see somebody every once in a while. But the bottom line is, we can work from home and do everything we need to do. And so anyway, back to what I was talking about earlier. If one of your goals is to have some guaranteed income, okay, and again, the guarantee is only as good as the company that's making it. You got to be careful there. You got to be as careful as you possibly can be. Do your homework. Do your due diligence. Okay, so, but if you wanted to know, you've got a certain amount of income you'd like to secure, you'd like to, or try to secure that. All right, I know I need this amount of money to pay my basic living expenses. How much would that be? You can go to this website and find out. It'll actually, you put your age in there and how much money you'd like to see, and it'll tell you how much money you need. If you did the other thing, you went in and said, all right, this is how much I have. How much can I get for that? That's fine. Either way. And it's very self-explanatory. It is a nationwide website. So again, just go to the internet, look me up or call us. The number is 330-664-0700 and check that out. You can always, I will meet you in my office for an appointment face to face. I'm not really afraid of the coronavirus. I'm pretty sure we had it. We have masks there for anybody that wants to come in. Hand sanitizer. You can stand 6 feet away. It's not a problem. We got plenty of room there. So I'm inviting you there. If you just want to talk about your situation, that's cool too. It's basically what I do. I talk, read, do a lot of research. Gary and Melissa administrate Fidelity and E-Trade Folio. We got whole staffs of people behind us that work at those firms. So anyway, I hear the music. That means my first commercial break is up. You're listening to Bill Bullington right here on 1420. Stay tuned because I'll be right back. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. Feel free to go to my website, bullingtoncapital.com. If you hear something that you'd like more information about during my show, feel free to reach out. I'll get back to you as quickly as humanly possible. It is a little bit slower since we're spending a lot of time working from home, and so are the companies that we deal with. That's been interesting to see how much that has slowed down. So anyway, but it's still pretty quick. You won't be on hold for long. And I've got a phone caller calling in. It's Adam. Is this Adam Ludicky?
Good morning, Bill.
Hey, how did I know?
I don't know. You've got the crystal ball in your office. You
Yeah.
probably carry it with you to the radio station.
Yeah, that one never works.
I had a question about a company that I got lucky. It started out as a trade, but I'm looking at it more as an investment. It's BG Foods.
Yeah, hang on a second. That's BGF? Is the
BGS.
symbol?
Yes.
BGF or BGS?
BGS, as in Steve.
Okay. All right. Yep.
And, well, my question was, at what point does that yield become unattractive to someone who wants to invest in the company? Right now, it's at 6.5%.
Yeah, right. And here's the thing.
In your opinion.
Yeah. So they make, I'm going to go to their website right now. Just from the numbers, revenues were $1.7 billion in the trailing 12 months, and they were actually up the last quarter compared to the quarter a year ago. That, by the way, the reason that you compare those and you don't compare 2 quarters in a row is because people don't buy nearly as many golf clubs in the dead of winter as they do in the spring. Does that make sense?
Yes.
So when you're looking at sales, you don't want to look at this quarter towards last quarter. It's great if they're up over that quarter. That's awesome. But you really want to look, because most businesses are a little bit cyclical or seasonal, I should say. You want to compare, say, the first quarter of 2020 to the first quarter of 2019. because of the cyclical nature of most businesses. Okay. And I'm not sure if anybody ever really talks about that a lot. I think it's just kind of a given in the financial services industry that any analyst already knows that. So they forget to tell the public about that. But you won't sell nearly as many winter coats in the middle of summer as you will in the fall.
Of course.
So it's just kind of common sense. But that's one of the things you want to do. And what this one is doing, it's showing the quarterly, so the last quarter versus the quarter a year ago, and I'm not sure it's as important with a company that makes food products, packaged food. But all other things being equal, it's still the way that we'd like to do it. And it's 8.88%. So that's pretty good. That's actually very good, despite the fact that, we've had all this stuff happening. Having said that, the profit margins on a company like that are typically somewhere between 5 and 10%, depending on how many brands they own. A brand, by the way, Procter & Gamble can charge a whole lot more money for their products because people are so familiar with them than a lot of other, generic manufacturers. So they're all, they stay pretty aware of that stuff, but they're setting their profits so that they can try to achieve a certain type of profit margin. And looking at this company, and food companies can be very profitable. This one actually fluctuates quite a bit more than a lot of other companies. I'm
taking on a lot of risk as a trade, and now I'm looking at, like I said, as an investment.
Yeah. Well, see, I don't know because
I'm looking at post-pandemic, and no one knows the future. So maybe a year from now, people might not be eating as much from home.
All right, well, here's the thing. They've got the market value of the company is about $1.7 billion or $1.8 billion. Okay, that's just the value of the stock. If you look at the revenue, it's $1.7 billion. So it's up just a little bit over 1 times. A company like that should be able to, in the long run, and I say this just having watched other companies similar to this company and this company in its history. So I have a basis for making this observation. It's not something I just pulled out of the air. It's something I just looked at. And being familiar with other companies like this company, Kraft Foods, there's a whole ton of companies that, you look at Hershey's, that could be comparable to this. So anyway, Kellogg's, you look at that and you go, okay, yeah, they should probably be able to maintain the profit margins that they have because that's pretty normal for the industry, especially when you've got some brands out there. And revenue growth is up a little bit, which is very good, especially in this environment. The profitability is very good. And so that dividend yield, they're paying out. It looks like they paid out almost all their profits as a dividend last quarter. That may not be all that good. But the bottom line is, across the board, it looks fine. Does that mean it can't go down? No. I mean, it's a stock. It can go down.
Yes.
It can go down a lot. But if it did go down a lot, this is one where I would be going, maybe I'll just pick up a little bit of that right now. By the way, here are some of I was just looking this up. They own Cream of Wheat, Devonshire, Durkee, Emeralds, and they own, Mama Mary's, Maple Grove Farms. These are just names that's what I meant by brands. Those are names.
Green Giant.
Yeah. So those are names that, So I look at that and go, the 6.5% dividend looks pretty good. Is it going to stay good? Your guess is as good as mine.
Okay.
But the bottom line is, this looks fine. If I saw that someone had this in their portfolio and wanted to know about it, like you're asking right now, it looks fine. The share price is, because it's a stock, it actually traded at its price back in 2012, and it's 2020 now. So it went way up, went up to like 48, close to 50 at one point in time, and during the pandemic was under 15. And most people will look at that and go, "Wow, that's too volatile." Well, that's a normal stock.
It's been bumpy.
Yeah, yep. So anyway, I hope that helps. I know most people that are listening will go, "Why don't you just tell us exactly what to do?" Because There's not an exact way of doing this. This is why you diversify. It's why you hold more than one stock or more than a handful of stocks, because you don't want to be wrong, especially when you start getting closer to retirement age. And I see that a lot. And that's kind of a rookie mistake, trying to put too much weight, too much emphasis on one company. If you like this company, I don't see any problem with adding it to your portfolio.
Okay. I did have one more question. You talked about a company, Overstock.
Yep.
How high? I mean, does this have you seen a stock like that?
Hang on. I got to get my crystal ball. Hold, 1 second.
No. I was setting you up.
Yep.
This just had an unbelievable run, but at some point, I mean, there's got to be some profit taking, Or
your
have
guess
you seen
is good
a
as
company
mine,
like
dude.
that?
I'm telling you, that's not what people want to hear. And unfortunately, it's part of my personality to tell you how it is, not what I think you want to hear. That makes me it makes me very, very unpopular with a lot of people,
right.
And especially at parties, But no, realistically, you don't know it. It's had a great run. That stock's been all over the map. If you look at it, go all the way back to its inception, it is amazing how much that stock goes up and down. And that's just one of the reasons I think you got to have a method here. You got to have a method. And it's not easy. And you've got thousands of people telling you their version of what they do, which is fine. But you got to find one that works for you, and that'll help you make those decisions. Overstock, by the way, I've always used in my momentum models. If I like it, I'll buy it. I'll put a stop on it because that stock is up and down a lot. Now, Overstock, for those of you that don't know who the company is, they're an online retailer, and they're kind of like an online Home Goods or an online TJ Maxx, where they buy stuff that didn't actually or wasn't selling that well, or somebody was trying to get rid of the inventory so they could get a new product in, and they're willing to sell it below normal costs or normal prices. Overstock will buy that, and then they'll sell it on their website. So it's been a very successful company. You see the guy coming up on Kramer's talk show all the time. He loves that guy for some reason, but he is an interesting guy. So but the stock, man, it is all.
I know
over
it's like going to Vegas. I know it's playing the roulette wheel with that.
Well, but see, when people play the roulette wheel, the odds are not in their favor. You can wait until the odds tilt slightly in your favor. Doesn't mean it doesn't guarantee a win. What it guarantees is that the odds were slightly in your favor. And in fact, in most games in the casinos, and I hate to talk about casinos and gambling too much. It makes people think I'm a gambler. I'm not. That's why I don't gamble. I know that the odds are not in my favor. Investing is trying to figure out what the probabilities actually are instead of just, I have a feeling. I want to get an idea of, is this overpriced or not? Is this something that fluctuates a lot or not? What does a company actually do to make money? So when you bring in up Overstock, you didn't call me ahead of today's show. I know that company. I know what they do. I know how they do it. I know what their profit margins are. I know what their sales have been. Okay, so when it comes up on a scan and I buy it, I think the last time I bought it was a few months ago. And it went up, was okay, got stopped out of it. Oh well, get stopped out, and now it's at a newer high. And I just didn't buy it the next time it came up because I already had the money redeployed someplace else. So, but I've been in and out of that stock a gazillion times, and I like it. I think
it's been a great trading stock.
Yes, it has.
Yeah, I know that.
From a long-term investor standpoint, it actually peaked in 2005 and is slightly below where it was in 2005. So from
now?
Yeah.
Wow.
Yeah.
Oh, jeez.
So that's my point. As a long-term investor, I'm not interested. Does that make sense?
Yeah, I know it's up 30-fold in the last 6 months or whatever. And
it was down 95% from the price that it reached in 2005.
Yeah. Okay, well, those are some good nuggets to follow.
Yeah. The main thing is to have an idea. You got to have some, and I like having multiple methods. I have two basic. I've got the momentum, which you know very well. You can go to Look Out for the Bull. That's explained there. Or I've got the value thing, which is basically a Warren Buffett. And what I try to do with the value thing is I try to get a decent idea of what the company's normal profit margins should be like. How do you do that? Well, you look at the company's own history, and then you look at the companies that are close by them. Because I can tell you this, when the CEO of that company goes into a board meeting and their profit margins are not as high as their competitors are, the board members want to know why. What are you doing or not doing that your competitors are? Because the board members are there to try to protect the rights of the shareholders. Okay? So there's a lot of pressure on the board itself because the board members can be sued for not doing their job. So the board members are going in and they're looking at the CEO and saying, hey, why? What are you doing? Why are you not matching the profit margins of at least the industry average? So there is a tremendous amount of pressure on these guys to be able to try to do whatever they can to get those profit margins in line with those of their competitors. Now, and if they're going to try to do something that they think is going to hurt their profitability for a little while, like Jeff Bezos from Amazon does all the time, they'll come out, those managements will come out and explain, here's what we're doing, here's why we expect it to cost us money, and we don't know whether or not we're going to succeed. Now, let me ask you a question. If your CEO told you that, would you invest with him? Probably not. Yeah. That's why he's one of the richest men that's ever lived, because he's willing to take those chances, and the guy is honest. And he fails a lot, and he admits it. And it's the only way you make success. A lot of people want to figure all the answers out in advance, and they get upset when they can't do that. Well, there's only one person I know that would be able to do that, and I haven't met him yet. Hopefully I will one day. I pray to him every day. So I might make it up there. But that's the only one that knows the future for sure. And if you really, when you try to know the future too well, or try to get it down, that's as risky as not paying attention to it at all. In my opinion. So you gotta find that middle road there somewhere. Understand not all your investments are going to work out. Just like Jeff Bezos, he talks about that a lot. It's why you diversify. It's why you try to pay attention to what's going on around you. Try to get to know yourself, how much risk you think you can actually take. Build your portfolio around that risk level. And if you don't know how to assess that, that's actually why I have a job. And that is my job. It's being a risk manager. Everybody's aware. Anybody can look up the sales and profits of any company that's publicly traded. That's not a trick anymore. That's available in a gazillion places online. Most people don't know what that means or what kind of risk they're taking when they're looking at those numbers if they invest in those companies. And that takes a while. It takes a while to get it down. Once you get it down, it's not what they want to hear, by the way. They want to hear that, hey, Apple's going to go straight up because they're going to split the stock, right? Well, no, I don't know that. And neither do you. And well, look, whoops.
Well,
hey, the music came on really loud.
Okay.
I guess they want me out there.
Thanks for taking my call. Enjoy your show as always, and look forward to talking more.
Thanks, Adam. Have a good weekend. You're listening to Bill Bullington right here on 1420. I'll be back after these messages, and we'll talk about some individual stocks for a change. And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can find this show as a podcast on iHeartRadio or at my website, bullingtoncapital.com, and you can reach out to me there as well, and we will try to get back to you as quickly as humanly possible. It's been interesting over the past few months doing all this work, most of it remotely. It's been kind of weird, actually, but it still works. It blows my mind. Anyway, if you want more information on the lifetime incomes, there's a part and a portion for just about everybody, but for a lot of people, some products are not the right fit. If you've got, I won't go into that today, maybe on next week's show, because it's just there's a lot to it. But bottom line is, if you were looking to guarantee a certain amount of income, then there's a product for that. If you believe that stocks are going to do extremely well and you'd like to participate in that, okay, there are products for that. If you're completely petrified, which a lot of people are right now because there's so much negative news out there, there's always going to be negative news no matter what. And that's one of the biggest challenges I think that individual investors have, is trying to see things clearly through a unbiased opinion or view. And everybody has biases. I mean, we all have biases. Trying to be aware that you have biases and being aware of what those are, that can be a trick sometimes. So anyway, bottom line is, you have to figure out kind of what you think you would like to try to achieve. And then if you don't know how to do that, then you call advisors, have them explain. And if you're not comfortable, call another advisor. The worst thing that could happen, I've met some very nice people over the years, and we did not agree on investment philosophy at all. And so, trying to do business, not a good idea. If somebody's deathly afraid of risk and wants to keep all their money in short-term bonds or CDs, well, great. You're going to get about less than 0.5%. That's amazing. But the good news is, you can probably work with someone, find someone that will try to get the balance between stocks and bonds right in your portfolio. Today, one of the reasons I've been talking about the lifetime income product, everybody that talks about these talks about, you get stock market returns with no risk. Well, first of all, that's not true. Everything has risk to it. There's some risk in there somewhere. You have to find out what that risk is, and is that the risk you want to take? Is that the risk that you're comfortable with? The risk-free returns right now are less than 0.5%. That's the risk-free. 0.5%. I had some guy, and I'll never mention anybody's name, but he wrote a kind of snarky email saying I should stop broadcasting that you need $1 million at 5% to make $50,000 a year because his clients are upset with him over that. And I'm going, okay, you see interest rates are like less than 1%, right? Yeah, that's simple math. First of all, I don't know what kind of calculators your clients are using. You might want to buy them one. But when you take let's say you put your money in a 30-year treasury bond at 1.19%, okay, 1.19%. That means that you're going to get $11,000, not $50,000, on $1 million. Okay, so if you wanted to be super safe, and that's not super safe, by the way. That's a 30-year bond. A 30-year bond. A 1-year treasury bill is paying 0.117. So when I'm not saying this to scare anybody, it's to try to bring them up into reality, because that's what you got to deal with. That's the way things are. Okay, and I know it's hard. That's why it's more important today than ever that if you don't do this, or some of the stuff that I'm talking about doesn't make sense to you, find an advisor. Interview 2 or 3, and if you're still not comfortable, just keep going. You got to be careful. You got to be careful, because there are a lot of advisors that are pretty shrewd. They'll just tell you what you want to hear. That's not in my system. I want you to try to do the right thing. I don't want to have to worry about remembering what I said. Because that's not a good way to live life. And I think, is it difficult out there? Yeah. Is it the hardest it's ever been? Nope. This is not the hardest it's ever been. It was really scary back in the early 60s when we were on the verge of a nuclear war. If they had Facebook and Google back then, people would be panicked much more so than they are about what's going on right now. If you go back to the Depression, holy cow. Or how about a world war where all the countries, as many countries, were actually at war at the same time? Okay. So when I think in terms of, is this bad? It's pretty rough. Is it the worst it's ever been? No. Is there nothing you can do about this? Absolutely not. Get a plan. Put a plan together. And it does not need to be complicated. Now, I know I talked about semiconductors and healthcare, and we will spend a couple minutes talking about individual stocks before the show's over. But those sectors, by the way, are in the funds that I hold in a broadly diversified portfolio. All the stocks that are in those specific sectors are in some of the funds that I hold. The difference between those models and the broadly diversified models is that they're concentrated in those. Now, you can add that to your portfolio with us. We do it all the time. But we're going to have a conversation about it because I want you to know, I want you to be comfortable with the amount of risk you're taking before you get in. And I don't want you going in under false expectations. And I can tell you that an awful lot of the time, people will come in and I'm not telling them what they want to hear. I'm telling them what it is, how it is. Look, if you're invested in stocks, they can go down 50%. You will not magically know when to get out. You will not magically know when to get back in. Anybody that's ever listened to one of my shows has heard me say that at least once. It doesn't stop some people from thinking, well, yeah, he'll still be able to do it because he's just saying, no, I'm not. I wouldn't do that. I promise you I wouldn't. You can get an idea. And by the way, this rally, the number of stocks investable by large funds that were showing a short-term uptrend never surpassed the number of stocks that were still in a short-term downtrend. That's a first. Yeah, or by a significant amount. And that's amazing. What that tells me is a bunch of different things. I'm running out of time here. I won't have the time to get into that. So if somebody can remind me, maybe send me an email to talk about that subject on next week's show. Just let me know. I'm going to take a real quick phone call here. I just have a few minutes left, and this is Herman.
Yeah, hello, Bill. I have a real quick question because a few months ago, you mentioned it was either an ETF or mutual fund. It might have been First Trust about high-quality dividend companies.
Right.
That it was one worth considering.
Yep.
Can you repeat the name of that?
Yeah, it was, again, emphasis on was worth considering.
Exactly. That's why I said it that way.
Yeah. Yep. Okay. So it was the First Trust Value Line Dividend Index. Yeah. So if you go look it up or just email me, I can email you a link to a page on it. It tells you about it. From its bottom price, it's up about 33%. And which is good. It's below its higher price, about, let me see, the higher price that it reached by about 14%. So it's still 14% off of its high, which is not uncommon, by the way. Most funds out there have not reached their old highs. The S&P is closer to its old highs than most funds are right now.
Okay, thank you, Bill. That was my only question today.
All right, well, thanks. Appreciate your call. Yep. Yeah, and I have that, by the way. I have, just to disclose to everybody, it's in my portfolio, and it's interesting. They have a very specific technique for selecting those stocks. If you'd like to know more about that, feel free. I will gladly forward you any information on that. That's not a recommendation, by the way. You are not allowed to do that. I just like the attributes of that fund. That's why I mentioned it. Okay. And I told you I would talk about individual stocks, and I'm going to try to. I got about 3 minutes here. So the Lookout for the Bull website is as the material on there, the training on it is free. The daily scans Mike Seeger publishes on a daily basis. He's been doing a great job. It's been a wild ride, as you can imagine, if you were doing that. If you're interested in learning more about that, feel free to give us a call in the office or send us an email. And the vast majority of it is on the website. I had intended on trying to cut a few videos for years now. I'm just paranoid about putting myself out there. But the basic information is all there, and it is free. I find that it needs to be emphasized before people actually get it, because they look at it. It seems so simple, they almost just dismiss it immediately. But I'm telling you, that's the bottom line. If you want to drive a nail, find a hammer and hit the nail on the head with the hammer. Now, that could be really tough for a 2 or 3 year old. Can you imagine that? But you should have seen my dad. He was a carpenter, and he never missed. He would never dent the wood. If he did, it was very, 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 very rare. So he was what would be known today as a finish carpenter if they didn't use nail guns. Today they use nail guns and doesn't leave a mark on the wood. Back in those days, when you missed the nail, you leave a mark on the wood. And depending on whose project it was, you might have to replace that whole piece of wood. Anyway, I hear the music. That means the show is definitely over. Thanks again, everybody, for listening. Have a good week, good investing, good luck. Go to my website, bullingtoncapital.com, if you have a question. And I'll see you again, or talk to you again next week.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.